December 9th, 2018. A 30-year-old man lies dying in a Jaipur hospital in India. His name is Gerald Cotten, CEO of Canada's largest cryptocurrency exchange, QuadrigaCX. The doctors call it complications from Crohn's disease. His new wife weeps at his bedside, and as his last breath fades, so does the only key to a massive $250 million in Bitcoin, money belonging to 76,000 people who trusted him with their life savings. The official story: a tragic accident. The truth? His exchange was a house of cards, his partner was a convicted felon, and those lost Bitcoin wallets? They were empty long before his death. This isn't just a collapse. It's one of the most audacious exit scams in crypto history. Welcome back to Bad People, where we deep dive into the most mind-boggling cases. If you haven't already, subscribe to our channel and hit the notification bell so you never miss any episode. The story begins in 2013 when Gerald Cotten and Michael Patrin launched QuadrigaCX from a small Vancouver office in British Columbia, Canada. What started as Canada's promising new cryptocurrency exchange quickly grew into a billion-dollar operation by 2017, riding Bitcoin's explosive surge. But beneath the surface, troubling signs emerged. Quadriga operated more like a shadowy startup than a legitimate financial platform.
So I created QuadrigaCX in 2013. We basically are now the largest exchange in Canada.
No corporate offices, no accounting department, just Cotten working alone from his encrypted laptop in Nova Scotia. As Bitcoin's value plummeted in 2018, panic set in. Customers flooded Reddit with complaints about frozen withdrawals and missing funds. Then came the shocking announcement in January 2019. Cotten had died suddenly during his honeymoon in India weeks earlier. The timing seemed impossibly convenient.
Horrible episode that starts with what just looks like traveler's diarrhea and then ends in 3 cardiac arrests and his death.
With Cotten gone, so too was access to $250 million in customer assets, the digital vault secured by passwords only he possessed. But blockchain investigators soon uncovered an even more disturbing truth. Those supposedly locked cold wallets had been empty for months before Cotten's death. Leaked chat logs revealed Cotten and Patrin had discussed scam opportunities years earlier, raising questions about whether Quadriga was ever legitimate or simply an elaborate con from the beginning. When bankruptcy auditors examined Quadriga's records, they pieced together a trail of deception spanning years. Cotten had been operating a classic Ponzi scheme, using new deposits to pay out withdrawals while secretly gambling with customer funds.
Cotten was operating Quadriga like a Ponzi scheme, so whenever people put in their money into the exchange,
he lost $115 million through fake accounts with absurd aliases like Aritu Ditwu, trading against unknowing Quadriga users. Another $28 million vanished in reckless bets on volatile altcoins. The personal enrichment was equally staggering. Cotten siphoned $24 million to fund his lavish lifestyle, luxury homes across Canada, a custom yacht, even a single-engine Cessna he never learned to fly. His widow, Jennifer Robertson, initially inherited most of these assets before returning $12 million in a court settlement, keeping nearly $100,000 in cash and personal items. Co-founder Michael Patrin's story proved equally dubious. After changing his name from Omar Danani, a convicted identity thief, he disappeared to Thailand following Cotten's death.
The announced closure of Vertex.
Wow. We think you should buy a really big boat.
The RCMP's 2021 raid on his Vancouver safety deposit box uncovered $250,000 in bundled cash and 45 gold bars, assets now subject to Canada's unexplained wealth laws. The haunting question remains: with so much money unaccounted for and so many red flags, was Quadriga's collapse truly about one man's death, or the inevitable unraveling of a carefully constructed fraud? The empty wallet suggests the money was gone long before Cotten's final breath in that Jaipur hospital room. The Quadriga collapse exposed gaping holes in cryptocurrency oversight that regulators are still scrambling to fix. When the exchange imploded, authorities found their hands tied by fundamental flaws in how crypto markets operate. Unlike traditional banks, Quadriga wasn't required to carry deposit insurance or undergo regular audits. Cryptocurrencies existed in a regulatory grey zone, not classified as securities under Ontario's oversight, and not recognized as legal tender by Canada's banking system. The cold wallet system that was supposed to protect assets became Quadriga's ultimate weapon against accountability. With no paper trail and no third-party verification, Cotten could move millions without anyone tracking the transactions.
As we expand globally and are able to tap into a lot of that market, we'll be able to grow and our profits will increase dramatically.
By the time regulators took notice, the damage was done. The Ontario Securities Commission's subsequent investigation confirmed what many suspected. Quadriga had been operating as a Ponzi scheme long before Cotten's death. Recent developments show governments learning from these mistakes. Canada's 2024 unexplained wealth orders targeting Michael Patrin's seized assets represent a new frontier in crypto regulation. Authorities can now force suspects to prove their wealth came from legitimate sources, a powerful tool against money laundering. But these measures arrive years too late for Quadriga's victims, raising difficult questions about whether any regulation could have prevented such a carefully orchestrated fraud. Quadriga's collapse offers brutal but essential lessons for anyone entering the crypto space. The first rule echoes through online forums like a mantra: not your keys, not your crypto. Keeping assets on exchanges means trusting strangers with your entire life savings, as 76,000 Quadriga users learned the hard way. Cold wallets, while less convenient, remain the only truly secure storage method. Vetting exchange founders is equally crucial. A simple background check would have revealed Michael Patrin's criminal past as Omar Danani, the convicted identity thief behind Shadow Crew's black market operations. Yet most investors never thought to look. The same due diligence applies to platforms themselves. Exchanges should provide transparent proof of reserves, showing exactly how much crypto they hold versus customer liabilities. Perhaps the most painful lesson is psychological. The get-rich-quick mentality that fueled Bitcoin's 2017 boom made investors ignore obvious red flags.
The cryptocurrency has gone from hitting a new record price yesterday to nosediving today.
Withdrawal delays, inconsistent accounting, and lack of corporate transparency were all dismissed as growing pains rather than warning signs. Now, those who lost everything spread their hard-won wisdom online, hoping to prevent future disasters. But, as we'll see next, some mysteries surrounding Quadriga may never be solved.
I lost 4 figures. If you were to add up all of their losses, it would be well into the 7 figures.
More than $1 million?
Yes.
The official report states Gerald Cotten died from complications of Crohn's disease on December 9, 2018, at a Jaipur hospital during his honeymoon in India. But the circumstances surrounding his death remain shrouded in disturbing inconsistencies that continue fueling speculation years later. Indian medical records show Cotten was admitted with severe gastroenteritis that rapidly progressed to septic shock. Yet, the attending gastroenterologist later confessed to reporters he remained uncertain about the exact diagnosis, with no autopsy ever performed to confirm the cause of death. The timeline raises eyebrows. Cotten had signed a new will just 9 days before departing for India, suddenly leaving his entire estate to his new wife, Jennifer Robertson. The document contained unusual provisions, including the $100,000 set aside for the care of their 2 chihuahuas. After his death, Robertson arranged for immediate embalming in India against standard procedures, making any future forensic examination impossible. When the FBI later investigated at the request of Canadian authorities, they found no evidence of foul play, but never exhumed the body for confirmation. Blockchain analysts uncovered another curious detail. In the months before his death, Cotten had transferred millions from Quadriga to personal accounts on other exchanges. The timing of these transactions, combined with the suspicious circumstances of his passing, led some investigators to quietly question whether they were looking at an elaborate exit strategy rather than a tragic coincidence. With no definitive proof either way, the mystery persists. Did Canada's crypto wunderkind meet an untimely end? Or did he execute the perfect disappearance? Jennifer Robertson emerged from the Quadriga scandal with a $12 million estate, while thousands of investors lost everything. The widow maintains she knew nothing about her husband's fraudulent activities, but the financial trail tells a more complicated story. Bank records show Cotten transferred $24 million to their joint accounts in the 2 years before his death, funding luxury properties across Canada, exotic vacations, and their lavish wedding. Robertson initially inherited nearly all these assets before returning $12 million in a 2019 court settlement that allowed her to keep $90,000 in cash, a Jeep Wrangler, and her wedding ring. Her social media presence before the collapse paints a picture of privileged obliviousness. Instagram posts showing private jet flights, 5-star resorts, and designer shopping sprees, while Quadriga customers begged for their frozen funds. Since the scandal broke, Robertson has maintained complete silence, refusing all interview requests and disappearing from public view. Her only statement came through lawyers.
I would have never, ever stolen from other people. The fact that he did what he did, I carry his shame with me.
Claiming she was shocked and devastated to learn about her husband's crimes. But with $12 million changing hands in the years before Cotten's death and her rapid legal maneuvering afterward, many victims question how much she truly didn't know. The full story of what happened behind closed doors may never come to light, just like the missing millions that started this whole mystery. The Quadriga scandal left behind more than just empty wallets. It exposed fundamental truths about cryptocurrency that every investor and regulator must confront. For those who trusted their savings to the exchange, the lesson is brutal but clear. In crypto, you either control your keys or you risk losing everything. Blind faith in platforms or charismatic founders can be catastrophic. For regulators, Quadriga was a wake-up call. Traditional financial safeguards failed because crypto existed in a legal gray zone. No audits, no insurance, no accountability. Now, with unexplained wealth orders and stricter oversight, authorities are playing catch-up. But the question remains, can regulation keep pace with an industry built on anonymity and decentralization? And for crypto itself, the biggest threat isn't hackers or market crashes, it's human nature. Greed, deception, and unchecked power turned Quadriga from a promising exchange into a cautionary tale. The technology may be revolutionary, but the risks are timeless. So, was this a tragedy, a scam, or something in between? The answer may lie in what comes next and who's willing to learn from the past. Before you go, if this story made you rethink how you store your crypto, hit that like button. For more deep dives into the wildest scandals, subscribe and turn on notifications. And in the comments, tell us, would you have seen through Quadriga's lies, or would you have been another victim? Your insight could help someone avoid the next big scam. Catch you next time.